Well, thank you very much yet again for asking me to discuss a paper here. This is fun. The goal of this paper is to understand why cash has increased so very much over the last 35 years. And it has two parts. It has some simple facts, like the facts, and it has a model that tries to explain the facts. That's a very sensible way to set up a paper. So let me start with the facts. There are 4 of them. So the fraction of R&D intensive firms has increased, and the fraction of R&D IPOs has really increased. So those are the 2 main facts. Cash holdings at entry have increased, but only for R&D intensive firms. For those firms, when they enter, they then take their cash balances down a bit, but only in the last 10 to 15 years. Those are the facts. Now we're going to try to make sense of the facts. And so we're going to make sense of the facts of a model. And so it's a very simple model. It's in the spirit of these dynamic models that I've been started with Christopher Hennessy that I've reviewed in this review paper with Ilya. So it's a dynamic industry model with 2 types of firms, endogenous entry and exogenous exit. Fairly straightforward. There are two types of firms. There's high tech, there's brick and mortar. And the fraction of each is fixed and given exogenously. I will come back to that in a bit. So these 2 types of firms have many, many things in common and 2 things not in common. So what do they have in common? They max the expected present discounted value of distributions to shareholders. Straightforward. They have a stochastic production technology that uses capital. Capital's in quotes for a reason. That will be explained later. They invest in capital. They incur adjustment costs. So how do they finance this capital accumulation program? Both of them have the option to accumulate cash balances or tap external equity markets, which is a costly activity. And then the last but not least is both types enter the industry when the value of the firm is big enough to overcome an exogenously given IPO cost. That's it. So that's what they have in common. There are 2 things that are different, collateral and debt. So the R&D intensive firms cannot use their capital as collateral. It's knowledge capital. And the brick and mortar firms have brick and mortar, so they can use it as collateral. So the R&D intensive firms have no debt because it's almost by assumption, and the brick and mortar firms can have some debt. There we go. Those are the differences. Now, what do they do with the model? They want to quantify the increase in corporate cash with this calibrated model, and they can replicate the 60%, which is a huge number. That's actually an admirably huge number. So a very large fraction of the corporate cash increase when they change the fraction of high-tech firms to brick and mortar firms. And they get that. That will do the whole thing, leaving everything else constant. Now remember, this makes sense because those are the guys who can't issue debt by definition. So this effect ends up dominating that decrease in cash that you see after entry for the high-tech firms. So there's a really nice insight in the paper about why the cash declines after entry. And the way to think about this, we have to step back a little bit and understand why cash has value in the model. Cash has value in the model because other sources of finance are costly. Cash is also costly because it doesn't earn a good rate of return by assumption. So you have a benefit, you have a cost, you have a nice interior solution, but the upshot of this is that you can just think of capital as another asset cash as another asset alongside capital that you can invest in. You've got 2 of them. One's a storage technology, one's a productive technology. So when capital productivity is low, you want more cash. They're substitutes. Very, very straightforward. And you can see this in the policy functions of the model. The nice thing about discussing this paper is it's so close to what I've done that I can solve it really fast. So that was fun. This is the policy function. So we've got the log shock to the production function along the horizontal axis and cash on the vertical axis. And don't worry about the units. Put them in whatever currency you want. And we've got the blue line, which is a large firm, and the red line, which is a small firm. So notice as the shock goes up, capital becomes more productive, the optimal policy is to hold less cash. Large firms want to hold more cash than small firms, and the reason is because of decreasing returns. So large firms have maxed out their returns to scale. They're getting close to where it's not good to accumulate capital anymore, so their capital is less productive, and therefore they want more cash. There you go. So keep that in mind. Now let's move over to the next bit. So shock mean reversion then drives this decrease in cash that you see after entry. So especially if you start with a low shock. So if you start with a low shock, then the shock's going to mean revert. And if you go back to the policy function, if say you start at negative 0.6, the shock mean reverts, cash is going to go down. That's it. Okay. Now, this is why changing entry costs can get you the stylized fact in the model. So what they do is they exogenously decrease entry costs. So for a long time ago, entry costs were high. When do you enter the industry? When your shock is really high and when capital's really productive and you don't have much cash. If entry costs go down, when do you enter? You enter when you have a low shock. There's not that much of a hurdle to jump over. And so capital's not very productive, you have more cash when you start. And then mean reversion gives you the decrease afterwards. Okay, so there, I outlined the model. I want to talk about a few things. I want to talk about there are just too many explanations for the increase in corporate cash, and I want to think about what the authors can do within their paper to deal with this. And there will be one unfair exaggeration, and I will apologize for it, so hang on. I want them to take the data more seriously, and I have a couple of extra things depending on how fast I talk, or whether Amir stops me early. So, there are by now many explanations for the increase in cash. So, my colleague Martin says that interest rates have gone down. My co-author Jake Zhao says that revenues and costs have become decoupled. So that would do it. I have this paper with Boris Nikoloff that says that ownership has decreased dramatically. There's the Falato Kaderzhanova and Sim paper that says that intangible capital has gone up. Bates, Cayley, and Staltz, which one is that? That's the, oh yes, uncertainty has risen, and these last guys, everybody's stashing their cash overseas because of differential tax rates. So many, many different explanations. Now, if all of these other papers can explain the entire, and that's, or at least most of the increase in corporate cash, how is it that these guys can too? And this all sort of reminds me of the equity premium puzzle. There are many, many explanations for the equity premium puzzle, and we have no idea which one is the most important. But I think they can fix this problem. But it is a problem because the focus on this industry composition is hardwired. And that's a terrible word, and I'm going to try to explain that it's not that bad. But first let me explain why it's hardwired. The fraction of new economy firms is exogenous. Entry costs are exogenous. The financial policy of the two types of firms is almost given exogenously because by assumption, one type of capital can be collateralized, one type of capital can't be collateralized. So if you increase the fraction of the firms that can't issue debt, of course you'll have more cash. That kind of makes sense. So I don't think this problem is as bad as it seems. If this were a theory paper, it would be a mighty bad problem. But it's not a theory paper, it's a measurement paper. And it's okay for a measurement error paper to have some of this type of structure because it makes it more transparent. So what do I think would make the paper a little bit more interesting? You have to, oh, see that dollar, that's a percent. I think you have to take the data more seriously. So they set the risk-free rate at 4%, which they got from one of my papers, and I can tell you where that came out. That just came because 4 is a pretty nice round number, and so there's no good reason to set the interest rate at 4%. In any case, We know interest rates, I'm good. We know interest rates have gone down. I would love to see what happens to their 60% number and whether they overshoot on the increase in cash if they also allow interest rates to go down. I thought that would be a useful thing to do. Another example is the volatility is constant over time. We know that the volatilities of cash flows have gone up. You can just measure that. It's in the data. Pardon? Cash flows. Yeah, the volatility of cash flows has gone up in this time period. We know that. You can measure it in the data. What would happen to their result if you let both things happen at the same time? Would you get this 60% increase? I could go on and on and on. You've got the idea. But I think it might be important because the mechanism in their model is tangibility, and the correlation cross-sectionally between tangibility and cash holdings is actually pretty low. I didn't know this. See each of those numbers? That's a 2-digit industry, and we've got average tangibility plotted against average cash holdings in each of those, I don't remember how many industries. And you can see there's 73, that's business services or software. They have high cash, low tangibility, and you've got the oil extractors who have low cash, high tangibility. But the correlation is not high. That regression R squared is low. And so there must be something else going on. So I think that there is a lot of room for the authors to use what I think is a very nice apparatus to understand more deeply the extent to which all these other mechanisms or their tangibility mechanism is driving the increase in corporate cash holdings. I think that that would make the paper substantially more interesting. That's my big stuff. And that I'm just also not a big fan of arbitrary parameterizations. They set the depreciation rate, they set the returns to scale, they set the interest rate. I've been playing around with these models forever. If you move those things, big changes happen. So it would be nice if you just let the data tell you what they are. And I think that's pretty straightforward. You don't have to calibrate anymore because computers are super fast. You did 10 years ago, but you don't now. It's just easy anymore. One last thing. I didn't like the distinction in the model between public and private firms. And that's more of a language issue, but it's kind of an important language issue. So the firms that enter into their model aren't actually producing anything. They're just sitting there at the sidelines waiting to jump in. And so calling them IPO firms isn't quite right because they're not producing. If they were producing, if they were real private firms, they'd never enter because they'd have to pay a cost and there is nothing would change after entry. So just change the language. But I do think that's important because you're not really talking about IPOs and non-IPOs. And that's also problematic because private firms hold different cash from public firms. Private firms have less cash than public firms, and that would actually go against your model. So I am done. I think this paper has a lot of upside potential. I think the facts are new and interesting, and I like the decomposition of the data, the no standard error decomposition. I thought that was quite nice. I think that using a model to understand the facts is a great way to go. I just wish that they would take the interaction between the model and the data more seriously. That's it.